according to a Hartford Fund study, if you miss the 10 best days in a stock market in any 30-year period, you would cut your returns in that 30 years by 50%. Market dips are normal. They happen. They're a part of the investing game. Just like if you was a basketball player and you miss a couple of shots in a row, maybe you miss 4 or 5 shots in a row. That's a part of the game. You don't quit and leave the game and say, I'm done. I'm taking my ball and going home because you missed 4 or 5 shots in a row. It's a part of the game. Just like the stock market going down and you losing a little bit of money is a normal part of the stock market game. So when the market goes down, don't trip and stay in the game. Guys, the stock market is falling fast. But if you're a long-term investor, this is exactly the time when you need to stay sharp. You need to stay focused and not be panicking at this time. Now, in this video, I'm going to give you some actionable steps, some things that you can really actually put into practice and do right now to grow your money and protect your investments, but also, more importantly, protect your sanity when we see the market falling like we see it is right now. Now, just last week, at the end of the week, the S&P 500 finished the week down almost 6%. Which is the biggest decline since March of 2020, 5 years ago, right? The S&P is now off about 17% from its recent high. Almost bear market territory, okay? Bear market territory is anything that's 20% down from a recent high. So the S&P is getting there. Now, when we look over at the NASDAQ 100, which is really tech heavy, that's where all of your big tech companies are. The NASDAQ 100 was down almost 6%, and the NASDAQ 100 is down 22% since December, 3 or 4 months ago. So the NASDAQ 100 is really in bear market territory, being down 22% in the last several months. The bottom line is stocks are taking a pounding right now. Almost all of your stocks are in the red right now. And in my opinion, look for more to come in the next week. All right, I don't think it's going to let up. It's going to keep being in the red. I don't know if we hit the bottom or not. I can't tell you if we hit the bottom, but I can tell you we're down, and I don't think we're going to see any recovery in the next several days. Now, not to mention, if you look at the overall economic climate here in America, we have a potential economic slowdown happening. We also have consumer sentiment, which is low. And when consumers feel bad about the economy, guess what consumers do? They don't spend money. And when consumers don't spend money, businesses have an issue, have a problem. And then you see more problems because you see the market come down even more because people aren't spending money the way they normally do, because people are scared and they're holding onto their cash and their money. And that's bad for businesses. And we also see the potential backlash of these tariffs that were implemented last week in terms of higher taxes being placed on America's imports. Now, what can that do for inflation? Perhaps raise prices. While we already have a sticky inflation, which is stuck around 2.8% in terms of the core PCE. And we know the Fed wants to get that down to 2%. They've been talking about it for about 3 or 4 years and it still ain't happened. So we have inflation that's sticky while we have tariffs, while we have people feeling bad and holding on to their money. There's a lot of things that are happening that says this is a pretty tumultuous time right now in terms of our economy, right? And the down stock market is a result of all of it. Now, the first thing I want to share with you is this. While all this is happening, it's very important that you don't panic. You don't give in to the fear that you're going to see. You're going to see video after video after video pop up in your YouTube feed that's going to try to scare you and frighten you and says, panic, panic, panic. Look, don't fall for the panic. Don't fall for what you see on CNN or NBC or ABC or Fox News where they got the ticker at the bottom about how horrible the economy is or something's about to happen. Panic, panic in the red. Listen, don't fall for it. Understand that fear sells, right? Fear is what puts money in people's pockets. So they got to scare you to get you to do certain things. They got to scare you to have you react a certain way. They got to scare you to make you watch, right? Scare you to make you read the article. Scare you to make you watch the video. Listen, relax. Don't panic, right? People don't have a problem making money off your fear, making money off you being scared. So be careful about what you watch. Be careful about the information you take in because it can affect your emotion, your mood. Yes, you will see a dip in your overall portfolio. It'll go from 200,000 to 150,000. It'll go from 30,000 to 25,000. It's going to happen, right? You're going to see some red in your portfolio of stocks or ETFs or index funds. But panic, listen to me closely. Panic is the enemy of wealth. Fear is the enemy of wealth. You have to normalize, if you want to be a good investor and you want to actually thrive in this type of situation when the market's going down, you have to sort of normalize the emotion of fear in the stock game. You have to reframe and refocus your idea around fear when you see a stock market that's going down like it is right now. Reframe your thought process. Look at fear as a time to review and not as a time to act irrationally, right? Look at fear as a time to analyze your portfolio and go back through your portfolio and perhaps make some moves in your portfolio to actually buy. You're reframing your mind frame about fear. Most people say fear, time to sell, time to sell. Well, look, the stock market's down. You wouldn't be wanting to sell your stocks right now in a down market, because when you sell in a down market, you're doing the exact opposite of wealth building. Wealth building is buy low and sell high, not buy high and sell low. So don't be out here giving into fear and being all upset and panicking. Look, you don't lose money until you sell, right? Technically speaking, right? You lose on paper, but you don't. If your portfolio went from 500,000 to 350,000, you ain't lost nothing because you ain't got rid of nothing. It's only when you sell that you lose. So relax, reframe fear as an opportunity to analyze and maybe invest a little more, as opposed to fear being an opportunity to all of a sudden be irrationally, emotionally angry, upset, anxious, and panicked. You may be better off not watching the news. You may be better off not scrolling on YouTube or not looking at your social media feeds right now when the market is down, depending on if you can stomach what's happening in the market. You can stomach these down markets because they happen, which takes me to the second thing I want to talk to you about, and that is remind yourself of your investment timeline when you see markets going down like this. In other words, if you have 5, 10, 15, 20, 30 years before you really need this money and you're a long-term investor, just chill. You good. You're not going to lose unless you sell, and you ain't selling in the down times. You don't have to do anything right now, but just keep doing what you're doing, right? You don't have to look at the stock market every day, right? You don't have to see it every single day. Seeing it is just going to make you more fearful and more scared and more anxious. Short-term volatility in the stock market, going way up and way down and way up, that's a normal thing. Look, market dips like we're seeing right now, almost to a bear market, market dips are normal. They happen. They're a part of the investing game. Just like if you was a basketball player and you play basketball and you miss a couple of shots in a row, maybe you miss 4 or 5 shots in a row. Guess what? That's a part of the game. You don't quit and leave the game and say, I'm done. I'm taking my ball and going home because you missed 4 or 5 shots in a row. It's a part of the game, right? Missing shots is a normal part of every single basketball game. Just like the stock market going down and you losing a little bit of money is a normal part of the stock market game. So when the market goes down, don't trip. Remind yourself of the timeline that you have and stay in the game. Keep shooting shots, right? Keep playing the game, dribbling the ball, passing the ball, reviewing your strategy, calling a timeout, 20-second timeout, full timeout, getting on the sidelines, seeing what you got, seeing how you can better manage, making adjustments here or there. But don't give up on the game and walk away from the game because you miss a few shots. Don't give up on the stock market and walk away and sell all your stocks because the market is down. It's just a normal part of the game. It happens. Now, the third thing is this: stay in the stock market. All right. Don't pull yourself and your money out of the stock market in down times. Please don't do that. Remember, time in the market always is going to be trying to time the market. There is a huge, huge cost to anyone who misses the best days in the stock market. I mean, misses the greatest gains, those days when you have these huge gains in the market, when it's been down for a while. There's a huge cost to missing those days. Let me explain. According to a Hartford Fund study, if you miss the 10 best days in a stock market in any 30-year period, you miss the best 10 days because you were trying to time the market, come in and out, in and out. If you miss the best 10 days in any 30-year stretch in the stock market, you would cut your returns in that 30 years by 50%. And here's the other kicker. The same study said that if you miss the best 30 days in the stock market in any 30-year period, you cut your gains by 83%. That's just missing 30 days out of 30 years. 83%. That's huge. That's a huge cut. Here's what it means. Stay in the market. A study from JP Morgan Asset Management found the exact same, pretty much the exact same thing, right? If you missed the top 10 days, I think their study was over a 20-year span. You cut your overall return by 50%. Just missing the top 10 days in 20 years was the JP Morgan study. But the point is this, stay in the market. Stop pulling your money out, getting your money back in, pulling your money in, because here's why. When you pull your money out, you don't know when that best, one of those top 10 days is going to happen. So when you pull out and the top 10 days happen, you miss out on big returns. So my plea to you is to stay in the market. Whatever you do, don't get out of the market because you don't know when that best day is going to happen, or the top 10 best days or top 30 best days. You don't know when they're going to happen. So you might as well stay in the market. If you try to time the market, you're going to lose, which leads me to something else. Keep dollar cost averaging, what we call DCA. Keep putting your money in certain amount, certain time intervals. Keep plugging your money in dollar cost averaging. Don't tell yourself, I'm not going to put money in. That's like if you say I'm not going to put money in a down market, what that says is, hey, I'm not going to buy the stuff on sale. I'm going to wait till it goes back to normal price instead of buying it when it's on sale. Look, they're selling some nice pairs of shoes over there, and I'm not going to buy the shoes when they're 50% off or 25% off. I'm going to buy the shoes, wait till the shoes get back to full retail price. You don't want to do that. You want to keep dollar cost averaging so you can continue to buy the dips. You can continue to buy in equities, right? Stocks, ETFs, index funds when they're on sale. You're getting your assets at a lower price in a down market. Trust me, the future you will thank yourself for doing so. And then another thing is this, you want to revisit your asset allocation. How are your assets spread out between what things do you have your money in? Is another way of saying asset allocation. Where is your money parked at? 10% here, 20% here, 40% here, right? Where is the money? You're investing, but how are you allocated? Maybe you need to revisit that in a down market. I'm not saying sell off everything for cash. I'm saying maybe you need to move some stuff around within your portfolio, right? Have you sat back and analyzed your portfolio recently? Is your portfolio still aligned with your goals and your risk tolerance levels, right? And ultimately, how are your assets spread out amongst all of your holdings? Are those percentages where you want them to be? Do you need to rebalance, right? It's not a time to just sell. It's a time to look at your stuff, analyze your stuff, and perhaps reallocate some stuff. And another thing is check your diversification. When you see markets go down, are you properly diversified to mitigate your risk? Or are you too overly exposed in an area? Do you have too much of your portfolio in the tech sector? Do you have too much of it over in crypto, right? Do you need more diversification, right? Do you have 99% of all of your stock portfolio in one stock or two stocks? Listen, there's so many benefits to spreading the love around and diversifying your overall investment portfolio. Me personally, I like to have a nice percentage in a broad-based index fund or ETF, the S&P 500 or something like that. And then I like to have my portfolio spread out between small cap and mid cap and large cap. And I have certain percentages in all those that satisfy me, as well as growth stocks and value stocks, or growth ETFs and value ETFs, right? Because I want a little bit of the stable stuff that's going to be around for a long time, right? The value companies, but I also want some potential for some growth, right? Some tech and some financials and things like that that have potential for growth. And me personally, in terms of my individual stock portfolio, I like to dibble and dabble in cyclical versus non-cyclical. Cyclical stocks being stocks that sort of change as the economy around us changes, right? But then non-cyclical stocks as well, which are stocks that basically are pretty much even. They don't change very much, right? We always need food. We always need a Costco, a place that's going to sell us our toothbrushes and toothpaste and paper towels or whatever, right? So I like to have some cyclical, I like to have some non-cyclical, some value, some growth, some mid-cap, small cap, and some large cap, some broad-based, right? So I like to have a little bit of all that in different sectors as well, right? Tech sector, consumer staples, energy, financials, financial services, some transportation, some industrials, right? So my point is this. You need to be looking at diversifying your portfolio across a number of things that you feel comfortable with that are in your plan, that are part of your strategy, right? And that includes some of the other types of investments, your gold and silver, your crypto, your bonds, your real estate, right? Do you have a mix of all these things? Let me give you an example of diversification. In 2022, the S&P 500 for the year was down about negative 18%. But at the same time in 2022, real estate took off in terms of prices for not just rents, but also prices of real estate itself, right? Single family homes, right? So if you had money in the stock market, you saw a lot of your money take a dip in 2022. But if you also was diversified and you had money in the real estate market, you saw your real estate go up. So you might have lost $50,000, $100,000 in the stock market, but you might have gained $50,000 or $100,000 in the real estate market. So diversification is really important. Now, another thing you got to think about is this. If you have a little extra cash and you see the markets go down, perhaps that's a good time to buy the dip, right? You want to purchase when things are low. Because remember, the primary rule of the stock market game is to buy low, sell high, or buy low and hold on. So when you see things low and on sale, maybe that's the time you need to take some of that extra cash and go buy this dip. Go buy some things when they're on sale. Go shopping, right? There's a reason in the last 6 months to a year that Warren Buffett has been holding on to cash, because he knows that when things go down, that's when I go buy. And he's patient enough to wait and say, when the market dips, that's when I purchase. Warren Buffett had more cash in the last year than he's ever had in 80 years worth of investing. And it's because he's waiting on the dips. So if you have cash, perhaps now is a good time to go purchase some stocks, some ETFs, some index funds, things that are on sale. But I also want to say that you want to make sure that any cash that you're using is cash that you can afford to lose. And it's not your emergency money that you're using to go take and to buy the dip. I don't want you doing that. I want you keeping some emergency money, right? Only use money that you can afford to lose. Now, what not to do? Let me just run over a few things what not to do. Again, don't panic. Relax. It's okay. When the stock market goes down and you don't sell, you only lose money on paper. It'll come back. And again, try not to time the bottom. And be careful about the financial gurus that you watch on which specific stocks to buy. Right? Don't listen to your favorite YouTuber and they tell you go out and buy this stock and you go out and buy it and the stock tanks. That's not that YouTuber's fault that you bought a stock that he or she said to go buy and it went bad. It's your fault for not doing your due diligence, right? Do your own research always. And then guys, I want to just remind you that crashes happen. Corrections happen. They are a normal part of the stock market game. The world is not coming to an end. You don't have to panic. You don't have to be anxious. Yes, your portfolio's in the red. It has dipped. It has dropped. You have lost money on paper. Yes. However, stay the course. We've known for 3 years or 4 years that the stock market has been overblown and stocks were overvalued. We've known that for several years. I've talked about it a bunch on this channel, that stocks are overvalued. They've been overvalued. These course corrections happen. How do we know the stocks were overvalued? Well, one of the best ways to figure out if the overall stock market is overvalued is just by looking at the S&P 500's PE ratio, price to earnings ratio of the overall index called the S&P 500. In the last 3 or 4 years, the PE ratio of the S&P 500 has been typically over 30 and 35 and up to 40. That's a problem. It's a clear indication that stocks are trading at a higher value than what they're really worth. And when you see that, it's an indication that there's going to be a crash soon and that a correction is coming. The PE ratio, and I'll let you do your own research on that because I don't want to dig too deep into it, but the PE ratio of the S&P 500 is safer when it's around the 20 mark, 15 to 20 mark, to 25 mark, much safer than the 30, 35, 40 mark. A lot of what we've seen in terms of overvaluation of stocks in the last 3 or 4 years is because we've been carried by the tech industry, the tech stocks, right? The S&P 500, the weighted S&P 500 is 30, 40, 50% tech stocks. And when tech stocks make up that much of the S&P 500, you're going to see more volatility. You're going to see more upswings and downswings in the overall stock market because tech sector has really been the driver in what we've seen in the overall stock market in the last really 5 or 10 years or more. And that's where we get these high PE ratios of the overall S&P 500 is because of the tech sector. But remember, typically these market corrections like we're seeing right now, these crashes, they happen every 1 to 2 years on average. You'll see. And then bear markets, which a bear market is when we have a 20% dip in the overall market from a recent high. Remember, the NASDAQ 100 is down 22% right now from a recent high. The S&P 500 is down about 17% from a recent high. So the S&P 500 is really approaching a bear market. Not there yet, but it may be this upcoming week. We'll have to wait and see if it happens. But those bear markets typically happen every 5 to 7 years. Typically, on average. Could happen every 3 or 4 years, could happen, not happen for 8 years, but on average, 5 to 7 years, you'll see a bear market happen, and we may be about to enter into one right now, right? Remember, 1999, right after 1999, when things went down, shwoom, market soared. Back in 2008, everything went down, shwoom. 2009, 10, 11, 12, market went way up. Remember, after 2020, everything went down. The next year, 2021, everything way up. 2022, things were down. 23 and 24, everything way up. So this too shall pass. Now listen, if this quick video helped you out or gave you something to think about, please do me a favor, smash that like button below. Also, share this video with somebody who you think needs to hear it and has their money in the stock market, and you talk to them about the stock market, and you talk to them about how to react and how to invest during this type of crash or down market. Share this video with that person for me. Really important. And what's your plan? What are you doing right now in this down market with your stocks, with your portfolio? Are you holding? Are you buying? Are you changing strategies? Are you looking at what you got and reallocating your portfolio in certain areas? Let me know what you're doing with your portfolio in the comments section below. I really would appreciate it. Now, if you're new to investing or you're an intermediate investor who could use a little more information about some of the basics, do me a favor and check out this video right here next.